what exactly are signals and how do you use them in investments?
Data which is converted into an actionable insight, which can potentially predict the performance of a stock or a company performance.
When you talk about your signals, your data sets,
We use both traditional and alternative data.
the process uses 400 different signals, and for an individual to process so much data or to look at so much data would be impossible.
These 400 signals are going in the stocks.
Human plus machine plus AI plus a lot of data goes into making Jio BlackRock Flexi Cap portfolio.
Correct.
Why are you bringing this systematic active fund in a Flexi Cap form? Hi, I'm Rahul Midda, Lead Sales Enablement for Jio BlackRock Asset Management, and I have with me a very special guest, Rishi Kohli, Chief Investment Officer for the AMC. Welcome, Rishi. How are you today?
Thanks, Rahul. Doing good.
Rishi, Jio BlackRock recently announced the flagship fund NFO, India's first systematic active equity fund. Before we get into the discussion on what systematic investing is, could you share a little with our investors on your journey and why did you decide to join Jio BlackRock?
Sure. So, my background and experience from the beginning of my career has been on data driven investment products on the public markets in India. And starting from the institutional derivatives market, where I was among the first people long back in 2001, to moving to the buy side and launching India's first quant and systematic fund in 2007, to launching Asia's first systematic managed futures fund in 2011, and also in the later years among the first public market long short hedge funds for India. So given that background and experience and the interest in the systematic and quant space, given Jio BlackRock's focus on systematic active strategies for India, it seemed like a natural progression, for me to latch onto this opportunity. So that is the first thing from my interest and experience side. The second and more larger objective was that BlackRock has a focus on data-driven systematic investment products globally, and Jio has a wide digital reach in India. And that combination coming into the asset management market in India seemed like the right thing at the right time, because with the explosion of data in India and the usage of tech platforms by majority of the population, this was an opportunity to have large financial impact and spread financial literacy across the length and breadth of the country, which resonated strongly with me because there could be large social impact, which is again close to my heart.
Thank you for sharing, Rishi. I think what I really liked hearing was that you've been a part of a lot of firsts, and Jio BlackRock is also going to bring systematic investing for the very first time. But taking a step back, probably say 2 years ago, when Jio BlackRock decided to enter Indian markets, could you share why did Jio BlackRock decide that I'll bring BlackRock's systematic way of investing into Indian markets? What was the thought process behind that?
Sure. So BlackRock has a global franchisee called SAE, in short, which is Systematic Active Equity in Full, which is a framework and process they apply to a lot of global markets, and have a lot of products on that platform. At the same time, for India, you don't have too many systematic and quant funds which are applying a scientific process to investing in public markets in India. There was a big gap there, which Jio BlackRock wanted to address. And therefore, thinking of a market like India from a systematic standpoint made a lot of sense for the joint venture. Secondly, the number of stocks in India have really increased over the last decade or so. And even the liquidity has improved drastically for majority of the top 500 to 1,000 stocks. Along with that, there's been a lot of data explosion where apart from fundamental data, a lot of alternative data is also possible to get now. And finally, the quality of the fundamental data, for example, has also increased a lot over the last many years. So all this combination lends itself very well to systematic style of investing, which is the unique case for India, which married with BlackRock's SAE expertise made a lot of sense for the joint venture to focus on.
Brilliant. A lot to unpack over here, Rishi. And few of the things what I got from your answer is that one, this is global, this has been tried and tested, and there's a gap which BlackRock or Jio BlackRock identified in Indian markets to bring this style of investing.
Correct.
But while we do want to get into what systematic investing is, but right off the bat, if I'm an investor, what is the benefit of systematic investing for me?
Yeah, in a very simple layman language, if I was to explain this, systematic at the core just means a rule based approach and a well defined process to investing.
Okay.
So you don't leave anything to gut feel or chance at all. And it is a scientific process. That is one. And the second thing is that it also eliminates all the cognitive psychological biases that we as humans have.
Okay.
So it brings a lot of discipline and filters out the noise fully.
Got it. Rule based approach, scientific process eliminates human biases. Would that be fair to say are some of the benefits? But in terms of, say, an outcome for an investor, especially when I look at markets today, I see a lot of volatility in my portfolio. How do systematic funds do they address this?
It depends. They can be all types of systematic funds, but the approach that we are following here is trying to dampen that volatility a lot. So, with lower deviation from the benchmark to focus on consistent alpha over the long term.
Got it, Rishi. So you're saying that there's a whole bunch of systematic funds, and at Jio BlackRock, we are trying to do a different, which we'll again get into in a minute.
Sure.
But taking a step back, what exactly is systematic investing? And based on your personal experience, how is systematic investing in Jio BlackRock different from systematic investing outside Jio BlackRock?
Sure. So, first part of your question, systematic investing, easier to explain via example. Cricket is so widely
Please.
followed in India. So, I'll take an example from there. Just think of the third umpire, the role he plays. So, normally, if there is, say, a run out, an umpire will have to give a quick decision based on limited things that he's seen in those fraction of seconds. And he doesn't have a lot of data to really analyze and come to a more decisive conclusion. But at the same time, a third umpire can look at the whole event unfolding from multiple different angles, multiple different cameras, the spy cam there, and therefore come to a much more informed decision using all the available data points and techniques at his disposal. So systematic investing is very similar to that you can combine a lot more data, a lot more signals, add a lot of things to the process. Like I said earlier, combine fundamental, traditional, and alternative data, and then create your portfolio. Rather than as a human, I mean, how many signals or how much data will you be able to track?
So you've mentioned signals a couple of times in this answer, Rishi. So what exactly are signals, and how do you use them in investments? Like while making an investment decision, what is the role of signals?
So, signal is nothing but data which is converted into an actionable insight,
Okay.
which can potentially predict the performance of a stock or a company performance. That is how I would define a signal. And like we discussed earlier, that signals can be across traditional and alternative sides. But when you combine all those signals, whatever be part of your process, and we can discuss that as we go along today. When you combine all those signals into a process whereby you're generating the portfolio, that is how it lends itself well to systematic investing.
Got it. So systematic investing is one, it uses a lot of data or signals to make investment decisions. Would that be correct to say?
Right.
Okay. Rishi, I was doing some research on the uses of alternative data sets in investing, and I think a story we all are living, our generation is living through, is AI, machine learning, and all this. It's fascinating when you think about all of this. So I'd like to ask you that, when you talk about your signals, your data sets, does Jio BlackRock use traditional data sets and alternate data sets? And what is the role of all of this AI, ML, alternate data in investments?
Sure. So, firstly, at Jio BlackRock, we use both traditional and alternative data. And in fact, we have like 4 buckets
Okay.
of valuation, quality, fundamental momentum, sentiment, in which we put all these traditional factors as well as the alternative data that we can look at, right? And traditional ones are simple fundamental ratios, fundamental metrics, which most of us are aware about. Simple examples are price to earnings, price to book ratio, earnings growth, sales growth, return ratios, return on equity, etc., operating margin. These are some of the traditional fundamental uh, data that goes in to our process. And then there is alternative data that goes in. Some examples there could be, for example, web searches,
Okay.
right? If there is web searches happening on an online retailer, for example, suddenly at certain point in time near the festivals or when a new product launch has happened, then it may be an advance indicator of, the sales rising in for that quarter, for example. So they can be early signals like this. Another example that comes to mind is credit card transactions. So suddenly, if a lot of credit card swipes have happened for a particular business, which is much above average or some extreme number, then again it can give advance insights into sales or earnings growth being much better, in that month or the coming quarter. Similarly, social media sentiment. So again, social media sentiment from a variety of sources can be, tracked, whether it's tweets or other discussions happening on discussion boards, etc., which can be tracked using AI/ML techniques, and you get an early sense of, okay, the sentiment towards the stock is suddenly shifting. So these are some of the interesting and simple to explain examples of data that can be used on the alternative side, and these are things that we are using in our process as well.
So different from, how we usually as individuals especially think about investments and, making an investment decision. I think it's fascinating to know that there's so much of data which is available out there, and the more data you use, the more better of an investment decision, or aim to make a better investment decision, you can do.
Yes. So, for example, I must also add that in our process here at Jio BlackRock, and especially for this upcoming Flexi Cap Fund, we are deploying a lot of AIML techniques, which are the latest and most advanced globally. For example, NLP techniques, also large language models for passing the text from broker analyst reports, company earnings calls, etc. And there are more than 400 signals that way that goes into the alternative data models that we have. And just a simple correlation to that is that, as a layperson, even if you had 400 data points that you could analyze, it was almost virtually impossible to analyze it just the traditional way. And therefore a systematic approach, which can combine all of this, combine all the traditional factors as well, and then come to a conclusion, makes a lot of sense.
Thanks, Rishi. So I think you mentioned that the process uses 400 different signals, and across how many stocks? Like, what is the investable universe you're looking at? And can you also tell, like, what comes to mind is, do all 400 of these data points or signals go into every stock which you're looking at? Because I think that, like you mentioned, for an individual to process so much data or to look at so much data would be impossible. You'd need a team of analysts, or your managers, to sort of go through all of this data, and thereby all those biases also start creeping in, which you mentioned at the beginning of the conversation.
So, yes, we start with a universe of more than 750 stocks for this fund and the process. And yes, these 400 signals are going in for each of these 750 stocks. The broad process is, as I mentioned earlier, those 4 buckets of different types of signals that we track.
Yeah.
Each of those 4 buckets has a mix of traditional data and signals and alternative data. And the alternative data is where these 400 signals are being analyzed. But that doesn't mean that it is different from the way the traditional signals are being used. Finally, in those 4 buckets, all these signals are going in. And then for each stock, there's a weighted average combination at some level of all the signals that comes up, which leads to what we call an alpha score for each of the stocks. And that is what in the end gives us the relative attractiveness of one stock versus the other. Let's say that relative alpha score is +3 for something and 0 for something else, then the +3 is better than 0, for example. There's a very, loose, broad way of explaining it, but
I'm
there'll be
sure
a
a lot
ranking of
more.
scores.
I'm sure a lot more of a lot more analysis goes into getting, that particular score.
Yes.
So, Rishi, and I know we've spoken about the investment process. We've spoken about, what this looks like. But say from the beginning to the end, could you walk us through what happens? Like, you start at 750 stocks, if I'm not mistaken.
Yes.
What happens in between and where do you end up?
Yes. So it actually directly relates to what we were just discussing. So, we can continue from there. So for all these 750 stocks, we'll get these alpha scores, right?
Okay.
And then there is an optimization engine in which the alpha scores for each of these stocks, there's a risk model that is there, which basically has some risk measures again for each of these stocks. So that also goes in. And then there is transaction costs, what we largely call a transaction cost model, but it will combine the normal transaction costs like brokerage and statutory taxes, etc. But that is standard across all stocks.
Okay.
But also slippage and impact costs. So when you trade, obviously your trade is also impacting the stock, and therefore you will not get exactly the price at which you're starting to do the trade at that point in time, right? So the difference between that and what you finally end up getting as your final execution is the what we'll call as slippages or impact cost.
Okay.
So even those cost analysis we have for each of the stocks. And then there is liquidity, average daily traded volume for each of the stocks. So all of this, the alpha scores, the risk model and the risk scores for each stock, and the transaction costs and liquidity for each stock, everything goes into the optimizer, which then throws out efficient, best combination of stocks in the portfolio and the weightages of those. So therefore, what ends up happening is at an overall concluding level, if you were to think about it, we aim to run a risk managed and cost controlled process, and the risks and the costs are already taken into consideration in the portfolio generation process itself, which is something that I've not seen too much in India in the past. And it is very interesting because rather than creating the portfolio and then worrying about risk and cost, uh, you know combining everything together in one process becomes very powerful. And again, it's only a systematic approach and the way in which we are defined this process that can achieve that.
Got it, Rishi. So I think a lot again to unwrap over here. I think you mentioned about risk management and cost efficiency. But before we get into that, I I think I have a bit of a different question. You're using a lot of data, you're using a lot of uh, models, you're using a lot of uh, things which what my question is that what is the role of fund managers? Where do fund managers come and how do fund managers drive this entire machine which is systematic active equity?
Sure. So there are a couple of places where the fund managers can add value. Obviously, one is at a larger level that continuous new research has to happen, and it is ever evolving. You have an edge. It can decay, alpha can decay over time, edges can decay over time. So you need to continuously do new research and bring new ideas and either new signals or new processes to the table. Maybe not for this, but for future funds. So that way, fund managers and researchers are always active and researching new ideas at all points in time. Specific to this fund and the process we just discussed, there are a couple of places where you could say there is a minor discretion that the fund manager has. But it's all again within the process. So, for example, there are stock sector bounds that a portfolio manager can have, right? So, we want to be very benchmark aware in this strategy because
Okay.
one of the larger goals is that we will not deviate in terms of risk from the benchmark too much, and what we term as active risk. So the aim is that the active risk for this scheme should be under 3 to 4% at all points in time.
So Rishi, for listeners who and more specifically, what I'd like to understand is when you talk about benchmark aware and when you talk about active risk, what do these two terms mean exactly?
Sure. So benchmark aware meaning that in this scheme, our benchmark is the NSE 500 index.
Okay.
So what we want to do is over time, obviously the objective is to have strong alpha, which means, top quartile returns largely. We don't care
Okay.
whether we are number one, number two, number three as such, but somewhere being in the top quartile and doing it over long periods of time consistently is what matters. Because if you see data of not only Indian funds but also global funds everywhere, the top quartile funds list keeps changing over a very long period of time. So one goal is for over long periods to be in that top quartile, and therefore benchmark aware means that we don't want to have too many decisions or weightages that are very different from the benchmark, right? And that is where the sector and the stock bounds that the fund manager has room to play with comes in, that finally it will be tightly constrained, right? There may be rules, and these are not hard fixed numbers. I'm just giving broad examples for this scheme. For example, we may say that, okay, plus minus 2% on a sector is the room that is there compared to the benchmark. So that ensures that you never deviate too much from the benchmark, and therefore you can never have too much extra risk. But at the same time, within that plus minus 2%, you have room to generate alpha. And those bounds a fund manager can tighten or loosen, but not like he can't make 2%, 5%. But that 2%, 0, or going back to 2, that flexibility he has based on the current developments that are happening. Let's say there is some active development in a sector, and every day there's new rules coming, new news coming, there's a lot of volatility that has increased. There it may make sense to completely tighten the bounds. Whereas in normal times, you may let the full constraint variation that is there run, right?
So you're systematic to the process where even what the fund manager does is systematic in nature. It is rule based. It is defined.
Yes, but from a risk management perspective is where he can come in. So even these variation in bounds and other things is more from a risk management perspective. Another thing that comes to mind is the corporate governance,
Okay.
which the process I described earlier. But in that process, finally, we have a list, which means the fund management and the research team together has put out a list, which is stocks slightly more susceptible to corporate governance risks or political or active news risks at any point in time. And there again, the fund managers have the flexibility to tighten the weight variations compared to the benchmark a lot. So you may run it exactly at benchmark or even lower, depending on the risk that is perceived from a corporate governance standpoint.
Got it, Rishi. So what I'm hearing is human plus machine plus AI plus a lot of data goes into making of the Jio BlackRock Flexi Cap portfolio.
Correct.
And I think you mentioned a lot about the risk management process. And going back to that bit, if we double click a little, would my understanding or would my statement of risk management is inbuilt into the systematic process, would that be a fair statement to make?
Yes, exactly. So risk management is paramount to the process. As I mentioned earlier, the risk model and risk scores are going into the portfolio generation process itself, which is not usually the case in most processes. So obviously that becomes very paramount. Otherwise, we wouldn't embed it into the portfolio generation and portfolio management process itself. Secondly, this benchmark aware and low risk compared to the benchmark and low deviations that we want even when strategy is going through a tough patch also means that the focus on managing that risk and controlling that risk a lot is fully there. And thirdly, the transaction cost and liquidity and other things that are also going into the portfolio generation process, they're also ensuring that there is no additional risk that is coming in because of higher impact costs or poor liquidity, which again can be there in a traditional process. So we are eliminating those potentials as much as possible. Obviously, you cannot eliminate all risks. You're getting return for a certain amount of risk you're taking.
Absolutely.
But the goal is that if the process lends itself well to controlling that as much as possible compared to the benchmark and still getting this top quartile returns that we were talking about, then it becomes a very powerful approach.
And that's what you're bringing to Indian markets.
Yes.
Rishi, now let's put this in a broader context. Like, I know you briefly mentioned how Jio BlackRock systematic investment method is going to be different from what's out there. But could you also tell us how is this different from factor-based investing? Because I think a lot of times we hear that at this point in time, value is doing good, or momentum is doing good, or quality is doing good. So how is a systematic process, one, different, and two, how does it account into these differences? Like, for instance, if momentum is doing well, how does your systematic process take this into consideration?
No, so firstly, largely systematic or quant, whatever you want to call it, will encompass all of these things. So the factor funds you're talking of would also fall under that.
Okay.
What we are doing will also fall under that. The difference though is that when you talk of factor funds, then they are taking those active factor bets, meaning that, like you mentioned, momentum or quality. So if I have a momentum approach as a fund, then I'm betting that on that momentum as a theme, broadly speaking, because factors not everyone understands. But
Yep.
as a theme, momentum easier to understand. Whatever has been doing well in the recent past will continue to do better. So in your ranking, you will give more weightage to those stocks, or in your portfolio, you will have those kind of stocks, right? In our approach, what we are following here in SAE overall and for this Jio BlackRock Flexi Cap scheme, what we are doing is we are not taking any active factor or theme bets. So
Okay.
we are trying to neutralize the factor exposures compared to the benchmark, and that's again related to the earlier benchmark aware and low deviation and therefore risk managed process that we were talking about. That is what we want, and therefore those factor exposures are neutralized in terms of the benchmark. Obviously, there will be factor exposures, but it will end up being very similar to the benchmark. So, therefore, the alpha that we are proposing and attempting to generate in the long run is pure stock specific alpha that we want to generate, because the sector bounds are already there, right? So, you will not have too many active sector bets as well. Little bit will come from there, but the larger part of it will come from stock specific alpha, and which is why that large focus on the different types of data and signals, and including alternative data, because all of that can help us get much better stock specific alpha over time. So that is what is very different, because if you break down any broad strategy or processes returns, there will be a market related return, then there will be a factor related return. You can reverse engineer that,
Okay.
and then what remains is the actual stock alpha. So our focus on that piece is very high compared to other factor or sector based approaches, which will have factor and sector bets.
So I think bottom line is that this is very different from what one is out there and from factor-based style of investing.
Yes, so definitely compared to other traditional funds and also other systematic or quant funds in the space, I think this is definitely a completely different approach and a first for India.
Thanks, Rishi. Shifting gears a little, can you talk about what is the relevance of systematic investing and flexicap as a category in Indian markets today? Like, why are you bringing this systematic active fund in a flexicap form?
Yes. So in a flexi cap format, obviously flexi cap means that we will be there across market cap segments, large cap, mid cap, small cap, and as we know that the relative attractiveness of the different market cap categories fluctuates over time. Sometimes small cap may be more attractive, sometimes large cap may be more attractive. So a flexi cap approach overall, at least lets the fund manager or the process have relative weightages which are higher or lower in the different market cap categories over time, which we think is a great thing for the current period where certain market caps seem overextended from a valuation and a price perspective, and certain don't. So flexi cap, I think, is timely from that angle. And secondly, a systematic approach, potentially can work well in a flexi cap kind of category, because you have more number of stocks to choose from.
Yep.
And our approach also, one thing I forgot to mention earlier, is that ends up finally having a very highly diversified portfolio.
Okay.
So we will at any point in time have 120 to 150 stocks in the portfolio. Typically, I mean, in some extreme scenario, it could be 100, or in some extreme scenario, it could be 160 also. But at most points in time, it will be in the 120 to 150 zone, which, as you know, is much higher than any other fund in that category, right? So most funds will have 30 to 50 or 60 stocks at max. So it is a much more diversified approach. The advantage of that is, again, going back to our risk management discussion,
Yes.
that it can keep risks under check, because I'm not overexposed on any one stock, and therefore any stock's idiosyncratic risk, any surprising news comes, shock comes, will not affect me as much as concentrated portfolios. So it manages my risk very well, but at the same time my approach is already attempting a certain top quartile alpha, so I'm not sacrificing the alpha for managing the risk, and therefore more diversified is better for me, because people go more concentrated to try and get that alpha. But if we can manage it with that diversified approach, it becomes very interesting.
Got it, Rishi. So what I'm hearing is that you're taking small bets across a large number of stocks rather
Exactly.
than having a large number of bets on very few stocks. And the reason why you're able to do this is because one, you have coverage on a broader universe, And second, you have the signals or data points across all these particular stocks.
Exactly. And another point to add there is that therefore we will also be doing weekly rebalancing
Okay,
compared to other funds which would be monthly or quarterly rebalancing.
got it.
Again, ours would be among either the first or among the very few that would do weekly rebalancing for two reasons. One, again, because mathematically difficult to explain here, but largely a true systematic and quant approach believes or mathematically proves that more number of stocks, which we just discussed, and more number of active bets over time leads to the long term results that your analysis is showing and your
Okay,
back tests are showing over time. So therefore, weekly rebalancing means more number of bets compared to a monthly or a quarterly, and therefore again gels very well with our approach.
got it, Rishi. So more bets, but risk control bets is the emphasis. And Rishi, a lot of times, like while we are having this conversation, and I absolutely love what Geo BlackRock is doing in the systematic space, we think in a very binary manner. We think of this or that, this versus that, rather than, this and that. So, where do systematic funds fit into a broader portfolio's context? One, do they fit in? And if they do, where?
Yes, so I think I'm in the and category. So I think traditional funds have a space, passive funds have a space, and systematic active kind of funds like the one we are launching has a space. The reason being that in any portfolio, it is again good to be diversified,
Yes.
right? You want to be diversified across equity and fixed income, for example, and then in equity, you can have these categories of index funds or passive funds, and then you can have active, which can be a mix of traditional fundamental and systematic or quant. Uh, and only when you combine all of this do you get a truly diversified portfolio for whatever risk return objective any investor may have. And therefore, that systematic part that should ideally be there, and globally it's very well proven, and which is why large AUMs are there in the systematic space, is something that makes a lot of sense for everyone in India as well. But because we've not seen too many funds in the space, so therefore the opportunity set has been limited to actually include it and have a much more diversified, much more efficient portfolio. This launch for us is the first in a series of systematic active
Systematic.
funds we will do. So hopefully we will be able to at least give a lot more opportunity and a lot more choice to all investors to have that allocation also and have a much better portfolio therefore.
Very interesting, Rishi. Rishi, we all know about the power of compounding. And I think you mentioned passive has a place. It's a low cost solution in investors' portfolios. And I particularly love this statement. I want to get this right. Small differences in cost can lead to big differences in returns over time.
Right.
Can you tell us a little about the efficiency in terms of cost in the FlexiCap fund which we'll be launching?
Yes. So in our upcoming FlexiCap launch, the total expense ratio is only 0.5%.
Okay.
I mean, we are direct, and even indirect, we'll be on the lower side of the category in terms of the expenses. So obviously the cost is low and therefore again efficient for any investor to come in and include a systematic approach in the portfolio. And the reason we are able to do it at low cost is because of the systematic process, because we are data driven and technology driven, and that helps us do things at scale, at low cost and with full efficiency. One example of that is the Aladdin platform that we have, which you and many listeners would have heard about. What that simply does is it's an end-to-end integrated platform which combines the portfolio management, the trading, the risk management, the compliance, the operations, everything into one platform. So if you can do that, then obviously you can control the costs, because otherwise there are a lot of costs and overheads and people that you will need in a traditional process, which is
Yep.
all eliminated in this. And those are the cost savings that we pass on to the investor.
So a more efficient way of functioning lets you save costs, which you're passing on to investors in the form of lower TERs.
Yes, and data and technology and systematic, that combination is what helps us do that.
Rishi, when we talk about risk management and we talk about consistency, can you simplify it for us with an example, or like how do we really put this point across on what we are trying to achieve?
Sure, yeah. So I'll go back to a cricket example, given the fact that we want to touch the length and breadth of the country. So something which everyone can understand in a very simple way. So think of it as, taking consistent singles and doubles and winning a match, which we've seen many examples of in the past of such matches, rather than trying to swing for the fences and hit boundaries, but also having the high risk of getting out, when you should not be getting out. So I would, relate that to the approach that we have, where it's like consistent small alpha getting added up regularly and building up over time, and not taking any extra risks to do that.
What we're trying to do is basically capture small alphas across a large number of stocks rather than aim for the fences or, aim for those two baggers, three baggers, and, build that risk into your portfolio by taking the smaller bets.
Correct. And then that small alpha can get added up and built up over time
Over
to
time,
achieve
it
the same
compounds.
objective anyway.
Got it, Rishi. Rishi, to summarize, why should an investor invest in Jio BlackRock's Flexi Cap Fund?
Sure, because it is data driven, technology enabled, highly differentiated, risk managed at very efficient cost.
That was lovely. Thank you for your time, Rishi. And to our listeners, do visit our website www.JioBlackRockAMC.com for more details.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.